This is not a story about faith. It is a story about capital. Behind chapels, hymns, and Sunday sermons operates one of the most disciplined wealth accumulation systems in modern America. Not a hedge fund, not a sovereign fund. A church, quiet, patient, tax-exempt, structurally insulated from the volatility that cripples corporations and governments. Every week, millions of members give 10% of their income, not as an investment, not as a fee, as obedience. The money arrives through recessions, market crashes, and political turmoil. It is predictable, it is scalable, and it compounds. There are no earnings calls, no shareholders, no disclosures like those demanded on Wall Street. There is only time. Decades of it, and time, paired with discipline, is the most powerful financial weapon ever created. This organization does not act like a charity that invests. It acts like a long-term asset manager that happens to be a religion. The system is simple. Guaranteed inflows, minimal distribution, long-term reinvestment, legal protection, cultural pressure that frames contribution as moral duty rather than financial choice. The result is a machine that grows quietly, largely unseen. When fragments of its balance sheet surface, the numbers shock even seasoned analysts. Tens of billions, vast land holdings, institutional-scale equity positions. None of this was accidental. It was engineered, not by miracle or prophecy, but by structure, by incentives that convert belief into capital and patience into dominance. The uncomfortable truth is this: America's most effective wealth machine did not come from Silicon Valley or Wall Street. It emerged from belief, rebuilt as a financial architecture whose true power was never spiritual. It was always financial. At the foundation of the Mormon financial system is a mechanism so simple it is often underestimated. The tithe, 10% of income, given regularly, without negotiation, without fluctuation based on market conditions, not suggested, expected. This is not charity in the conventional sense. It functions far closer to a voluntary tax, one enforced not by law, but by culture, belief, and social reinforcement. Members are taught early that tithing is not optional generosity. It is obedience, a baseline requirement for full participation in religious life. From a financial perspective, this creates a revenue stream, unlike almost anything else in the modern economy. Most institutions struggle with volatility. Governments depend on tax cycles. Corporations depend on consumer confidence. Donations to charities spike during good times and collapse during recessions. Tithing does none of that because it is framed as a moral obligation rather than a discretionary expense. It remains remarkably stable even when personal finances tighten. Millions of individuals contribute independently, spreading risk across households, industries, and regions. No single donor matters. No single downturn threatens the system. What emerges is a revenue base that is diversified by default. The discipline matters as much as the percentage. Tithing is not occasional. It is continuous, weekly, monthly, annually, tracked, reviewed, and internalized as routine. Over time, it becomes invisible to the giver and indispensable to the institution. Just as important is the absence of earmarking. Donors do not direct where their money goes. They do not vote on budgets or demand transparency. The capital flows upward, centralized, free from restriction. That allows long-term planning without interference from short-term sentiment. In financial terms, this is ideal capital. It carries no repayment obligation, no interest, no maturity date, and no external accountability comparable to public institutions. But the true power of the tithe is psychological, because contribution is tied to worthiness and identity. Non-payment carries social and spiritual consequences. Participation in certain religious rites depends on compliance. The system does not threaten punishment. It withholds belonging. Over decades, this model produces something extraordinary, a permanent inflow of capital that behaves less like donations and more like sovereign revenue, except it is entirely voluntary, legally protected, and culturally enforced. Before any investments are made, before a single dollar is compounded, the system has already won. It has solved the hardest problem in finance: reliable capital. Indefinitely, stable capital alone is not enough to build a financial empire. What turns consistent inflows into lasting power is governance. And this is where the Mormon system separates itself from ordinary religious organizations. At every level, the institution is built on standardization. Local congregations collect tithes, but they do not control them. Funds move upward through a rigid hierarchy, following identical procedures across regions, countries, and cultures. The rules do not change. The language does not change. The expectations do not change. This uniformity eliminates friction, confusion, and local deviation. Decentralization exists only at the collection point. Once the money is received, authority re-centralizes immediately. Local leaders cannot redirect funds, create independent budgets, or experiment with alternative uses. This prevents fragmentation and ensures that capital is deployed according to long-term institutional priorities rather than short-term local needs. Oversight is internal, continuous, and procedural. Audits are conducted regularly, not to inform the public, but to enforce compliance within the system. Leaders are trained to treat financial administration as a moral responsibility, not a managerial choice. Errors are framed as failures of discipline, not mere accounting mistakes. This internal audit structure replaces external scrutiny. Because the organization operates under religious protections, it avoids many disclosure requirements imposed on corporations or charities. Accountability flows upward, not outward. The system answers to itself. Standardization also extends to leadership rotation. Local financial stewards are frequently reassigned, limiting the opportunity for entrenched corruption or personal empires. Authority is temporary. Procedures are permanent. This reduces individual risk while strengthening institutional continuity. From a financial perspective, this model is exceptionally efficient. Administrative costs are tightly controlled. Redundancy is minimized. Decision-making is centralized and insulated from public pressure. There are no donor committees, no votes, no debates over allocation. capital moves according to plan. Most organizations fail not because they lack revenue, but because they lack control. Money leaks through inefficiency, internal conflict, or misaligned incentives. Here, leakage is designed out of the system. By combining disciplined inflows with rigid governance, the institution achieves something rare: a financial structure that scales without losing coherence. As membership grows, complexity does not explode. It compresses. This is not accidental management. It is institutional engineering, designed to turn belief into a perfectly administered financial machine. At a certain scale, money given for maintenance becomes money capable of multiplication. This is the inflection point where donation ends and capital formation begins. And it is the moment the Mormon financial system quietly crosses into a different category altogether. In most religious institutions, contributions are consumed quickly. Buildings, salaries, outreach, charity. The money flows in and flows out. Little remains. Growth is limited by the next wave of donations. The system stays fragile. Here, the logic is different. Only a portion of incoming tithes is used for operational expenses. The rest is retained, stockpiled, protected. This surplus is not treated as excess. It is treated as seed capital, money set aside, not for today's needs, but for decades of tomorrow. Once retained, capital is no longer moral contribution. It becomes a financial resource. It can be deployed, diversified, and compounded. And because the inflow is constant, accumulation accelerates quietly, year after year. The crucial advantage is freedom from donor control. Contributors do not earmark funds. They do not track performance. They do not demand returns or reports. Once given, the money is institutionally owned, untethered from the individual who provided it. This allows long-term strategies that would be impossible under public or shareholder pressure. There is no obligation to distribute gains, no expectation of visible impact. Capital can sit dormant when markets are unfavorable and move aggressively when conditions align. Time becomes a strategic asset. This is the core transformation. Donations are temporary. Capital is permanent. Donations end when giving stops. Capital continues working long after the giver is gone. In financial terms, the system has solved two problems simultaneously. First, it generates surplus at scale. Second, it converts that surplus into investable capital without friction, oversight, or redemption risk. What emerges is not a charity with savings, but an institution with a balance sheet mindset. Assets are preserved. Growth is prioritized. Risk is managed quietly, internally, and over long horizons. Once this threshold is crossed, the organization no longer depends on faith alone for survival. It depends on returns. And at that point, belief is no longer just a spiritual force. It is the engine of capital formation. Once capital is formed, the real advantage begins to reveal itself, not through risk, not through speed, but through compounding. Compound interest is often described as a mathematical principle. In reality, it is a structural advantage reserved for institutions that can wait. Most cannot. Corporations face quarterly pressure. Governments face election cycles. Charities face constant demand to spend what they receive. Time is their enemy. Here, time is the asset. Because capital is not expected to be returned, redeemed, or visibly deployed, it can remain invested across generations. Gains are not extracted. They are reinvested, or loss are absorbed without panic. Volatility becomes background noise rather than existential threat. This patience changes everything. A modest annual return, sustained over decades, produces exponential outcomes. 10 years is useful. 20 years is transformative. 50 years is dominance. Compounding does not need aggressive strategies or public justification. It only requires consistency and restraint. The institution does not need to outperform markets. It only needs to remain in them. While others are forced to sell during crises, this system continues buying. While panic spreads, it remains structurally calm. Recessions become entry points. Crashes become accelerators. There is no marketing campaign celebrating this growth. No performance benchmarks released to the public. No incentive to impress. Silence is not weakness here. It is protection. The less attention drawn, the longer compounding can operate uninterrupted. Crucially, this system avoids the most common enemy of long-term returns: distribution pressure. There are no beneficiaries demanding payouts. No political constituencies insisting on immediate use. Capital is allowed to remain capital. Over time, compounding produces an asymmetry that outsiders struggle to grasp. The institution begins earning more from existing assets than from new contributions. At that moment, the system becomes self-sustaining. Donations fuel growth, but returns quietly take over. This is where scale stops being visible and starts being structural. Compound interest does not announce itself. It does not persuade. It does not recruit. It simply accumulates year after year, protected by time, discipline, and invisibility. In the end, this is the most powerful weapon in finance, precisely because it does not look like one. It requires no advertising, only patience. Capital formation and compounding explain growth. Tax exemption explains why that growth faces so little resistance. Religious status provides a structural advantage that no private fund, corporation, or sovereign vehicle can fully replicate. Income is shielded. Capital gains are untouched. Reinvestment occurs without erosion. What would normally be taxed, regulated, or disclosed instead moves quietly through protected channels. This is not a loophole. It is a design feature of the legal system. In the United States, religious organizations are exempt from federal income tax and largely insulated from the reporting requirements imposed on nonprofits, endowments, or financial institutions. There is no obligation to publicly disclose balance sheets, investment strategies, or internal allocations. Transparency is optional. Oversight is minimal. Enforcement is rare. For a capital-intensive system, this changes the math completely. Every dollar earned through investment remains intact. No percentage is siphoned off for taxes. No drag slows compounding. Over decades, even small differences in tax treatment produce enormous divergence. What appears modest at year 5 becomes overwhelming by year 50. Just as important is the absence of external accountability. Public companies answer to shareholders. Funds answer to regulators. Charities answer to donors and watchdogs. Here, accountability is internal and doctrinal. Financial decisions are framed as stewardship, not performance. Scrutiny is moral, not numerical. This insulation allows long-term strategies that would be politically impossible elsewhere. Capital can be accumulated without public justification. Assets can sit idle without criticism. Growth can occur without signaling success. The system also benefits from classification ambiguity. It is not treated as a bank, despite managing vast capital. It is not treated as an investment firm, despite behaving like one. It occupies a protected category, where scale does not automatically trigger regulation. This creates asymmetry. Competing institutions must optimize around taxes, disclosures, and public reaction. This one does not. Its effective return is higher before a single investment decision is made. Tax exemption is often defended as a protection of belief. In practice, it functions as a multiplier. It amplifies discipline, rewards patience, and shields accumulation from interference. At scale, this advantage becomes decisive. Capital does not just grow faster here, it grows uninterrupted. As capital grows and tax protection locks in returns, a new requirement emerges: invisibility. At this scale, secrecy is not an accident. It is a strategy. Rather than managing assets in the open, like public endowments or charitable foundations, the system channels its surplus into closed investment structures. These entities do not solicit outside capital. They do not advertise performance. They do not communicate with donors. Their sole function is preservation and growth. This is secrecy by design. Closed funds eliminate the two greatest threats to long-term accumulation: public pressure and internal expectation. If donors saw the full scale of accumulated wealth, questions would arise. Why continue giving? Why not spend more? Why not redistribute? Transparency would introduce friction into a system optimized for patience. Silence prevents that friction. The investment arms operate with institutional discipline, but without institutional visibility. There are no press releases announcing returns, no rankings to climb, no incentive to chase short-term gains for reputational benefit. The mandate is singular: protect the capital and let it grow. This structure also limits regulatory exposure. By avoiding public fundraising and maintaining internal ownership, these funds sit outside many oversight mechanisms that govern financial institutions. They are neither hedge funds nor charities in the conventional sense. They exist in a legal gray space where scale alone does not trigger scrutiny. Internally, access to information is tightly restricted. Decision-making authority is concentrated among a small circle of trusted stewards. Knowledge is compartmentalized. Most members, including local leaders, have no visibility into asset size or strategy. This reduces internal dissent and eliminates the risk of narrative leakage. From a financial perspective, secrecy functions as risk management. Markets react to attention. Politics reacts to numbers. By remaining quiet, the system avoids becoming a target. There is no reputational premium to protect, only capital. This approach also neutralizes comparison. Without benchmarks, there is no failure. Without disclosure, there is no underperformance. The fund does not need to prove competence. It only needs to endure. When fragments of information eventually surface, they appear shocking precisely because they were never meant to be seen. But by then, the system is already too large, too embedded, and too insulated to be easily disrupted. Secrecy here is not concealment of wrongdoing. It is the preservation of structure. A closed system does not invite questions. It simply compounds. At a certain scale, accumulation creates a problem no doctrine anticipates. The system no longer struggles to fund its mission. It exceeds it. This is the moment when capital begins to outgrow purpose. Operational costs are covered many times over. Buildings are paid for. Programs are stable. Emergency reserves are full. And yet, the inflow does not slow. Tithes continue. Returns continue. Compounding accelerates. The machine keeps producing surplus long after necessity has been satisfied. At this stage, the organization is no longer managing scarcity. It is managing excess. The question quietly shifts from how do we sustain the mission to what do we do with capital that has no immediate religious use. The answer, structurally, is almost inevitable. Retain it, protect it, grow it further. This creates a feedback loop. Large reserves justify long-term investment. Long-term investment produces larger reserves. The system becomes increasingly oriented toward preservation rather than deployment. Spending becomes risk. Holding becomes virtue. What emerges is a divergence between narrative and function. Publicly, the institution remains framed as a faith-based organization serving spiritual needs. Internally, it behaves like a capital steward optimizing balance sheet strength across generations. Importantly, this is not framed as greed. It is framed as prudence, as preparation, as responsibility to the future. Excess capital is justified as insurance against uncertainty, economic collapse, legal threats, societal change. The more uncertain the world appears, the stronger the argument for accumulation becomes. But scale changes perception. When reserves reach tens of billions, the concept of rainy day begins to stretch credibility. Capital is no longer defensive. It is strategic. It confers optionality, the ability to influence outcomes without immediate disclosure or explanation. At this point, the institution's survival no longer depends on belief alone. Even a dramatic decline in membership would not threaten solvency. Returns can sustain operations. Assets can absorb shocks. The system becomes structurally independent from its original base. This is the inflection point where capital stops serving the organization and the organization begins serving capital. Not consciously, not maliciously. Structurally, the mission still exists, but it is no longer the constraint. The balance sheet is. Once capital reaches surplus scale, it seeks stability, and no asset class offers stability, control, and influence, quite like land. At this stage, the institution's behavior begins to resemble that of a diversified holding company. Capital flows into real estate, commercial developments, agricultural land, and operating businesses, not as side projects, but as core pillars of asset preservation. Real estate serves multiple functions simultaneously. It stores value, it generates predictable income, and it anchors power geographically. A building is not just an asset, it is presence. A shopping center, an office complex, a residential development, each embeds the institution into the economic fabric of a city. Land acquisition extends this logic further. Agricultural holdings provide inflation resistance and long-term appreciation. Undeveloped land offers optionality, future development, leasing, or resale when conditions align. Unlike financial instruments, land does not vanish in crises. It waits. Operating businesses add another layer. These enterprises produce cash flow independent of donations. They diversify revenue sources and reduce reliance on membership growth. The organization begins to earn not just from belief, but from rent, sales, and production. Structurally, this mirrors corporate strategy. Diversification reduces risk. Tangible assets stabilize balance sheets. Cash-generating subsidiaries fund expansion without drawing public attention. The difference is not behavior, but classification. Because these assets sit under a religious umbrella, they avoid the scrutiny normally applied to corporate conglomerates. Holdings are not marketed as a portfolio. They are framed as stewardship. Scale is normalized. Expansion appears organic rather than strategic. Over time, this transforms the institution's relationship with its environment. Local governments negotiate with it. Communities depend on its developments. Employment, zoning, and infrastructure decisions begin to intersect with its interests. Influence grows without overt lobbying. The narrative remains spiritual. The mechanics are unmistakably corporate. At this level, the organization no longer resembles a faith group that owns assets. It resembles an asset manager that happens to own faith-based legitimacy. The distinction matters. Because corporations must justify expansion to investors and regulators. Here, expansion is shielded by doctrine and tax status. There is no earnings pressure, only accumulation pressure. No activist shareholders, only internal stewards. When religion reaches this scale, it stops behaving like a mission. It behaves like a firm. And firms, when properly capitalized, do not ask whether they should grow. They ask where. Every financial system creates winners and absorbers of cost. In this one, the distribution is asymmetrical. On the surface, participation appears voluntary and equal. Each member gives the same percentage. Each is told the sacrifice is shared, but structurally, the burden is personal, while the benefits are collective and centralized. For individual members, tithing is immediate and irreversible. It is paid before savings, before discretionary spending, often before financial security is fully established. For households under strain, the cost is real. Delayed education, reduced safety nets, postponed investment. These decisions compound in the opposite direction. At the institutional level, the experience is inverted. Capital arrives aggregated, insulated from individual hardship. Loss at the household level is invisible to the system. Gains at the system level are permanent. This asymmetry is not enforced through coercion, but through moral framing. Contribution is linked to worthiness, belonging, and identity. Compliance is rewarded with access, status, and community integration. Non-compliance carries social and spiritual consequences, not punishment, but exclusion. From a financial standpoint, this is an extraordinarily efficient transfer mechanism. Millions absorb small personal costs. The system absorbs massive collective benefit. Risk is externalized downward. Stability is centralized upward. Crucially, there is no direct feedback loop. Individual contributors do not receive proportional benefit from institutional wealth growth. Returns do not flow back as dividends, reduced contributions, or expanded financial relief. The balance sheet strengthens, but obligations do not. Over time, this creates a quiet tension. The organization becomes increasingly wealthy, while many of its members remain financially constrained. The gap does not provoke immediate rebellion because the framing is spiritual, not transactional. The cost is justified as eternal investment, not economic exchange. Yet structurally, the system begins to resemble a regressive tax. The percentage is flat, but the impact is not. 10% means survival trade-offs for some, convenience for others. The institution, however, experiences only the aggregate sum. This model is sustainable precisely because the pain is distributed and individualized. No single contributor bears enough weight to threaten the system. The institution, meanwhile, compounds uninterrupted. The result is a form of capital accumulation that is socially invisible but financially decisive. Individuals carry the weight. The system carries the wealth. Systems built on invisibility eventually face a moment of exposure, not because they fail, but because scale attracts attention. For years, the institution's financial architecture operates beneath public awareness. Assets accumulate quietly. Returns compound silently. But when fragments of information begin to surface, through whistleblowers, regulatory filings, or investigative reporting, the narrative shifts abruptly. What was once framed as stewardship becomes a question of scale. Journalists and analysts do not uncover mismanagement. They uncover magnitude. Tens of billions in reserves. Sophisticated investment strategies. Structures resembling institutional asset managers rather than religious charities. The shock is not that the system exists, but that it is far larger than anyone expected. Legal scrutiny follows perception, not wrongdoing. Regulators examine whether disclosure obligations were avoided, whether tax exemptions were stretched, whether internal representations align with external reality. Lawsuits emerge not over theft, but over transparency, what members were told, what was withheld, and whether omission constitutes deception. The media amplifies the contrast. Headlines juxtapose modest congregations with enormous balance sheets. Individual sacrifice is placed beside institutional abundance. The framing becomes unavoidable. Why does a religious organization need this much capital? Internally, The response is defensive, but controlled. There is no panic sell-off, no sudden restructuring. The system was built to withstand noise. Statements emphasize prudence, long-term security, and responsibility to future generations. The accumulation is framed as protection, not excess. Critically, exposure does not immediately weaken the structure. Assets remain intact. Legal protections remain in place. Membership does not collapse overnight. What changes is legitimacy pressure. The institution must now operate under observation. This is where the design reveals its final strength. Because capital was accumulated without reliance on public approval, its survival does not depend on public forgiveness. Even sustained criticism does not threaten solvency. The machine can absorb reputational damage the same way it absorbs market volatility, by waiting. Investigations come and go, media cycles move on, but the assets remain. Exposure introduces friction, not collapse. It slows expansion. It invites oversight, but it does not dismantle the structure. By the time the world understands what was built, the system is already too large to be easily undone. That is the paradox of late discovery. When secrecy breaks, power has already settled. When scrutiny arrives, the system does not retreat. It reframes. Rather than engaging critics on financial terms, the institution shifts the conversation back to mission. Accumulation is not defended as success. It is justified as responsibility. Wealth is not described as excess, but as preparedness for uncertainty, for crises, for a future only the institution is patient enough to anticipate. This is narrative control, not denial. Public statements emphasize charity, education, humanitarian aid, and moral stewardship. The language is deliberate. Capital is never framed as power. It is framed as protection. Critics speak in numbers. The institution responds in values. Internally, messaging tightens. Leaders reassure members that nothing has changed. Contributions are still sacred. Trust remains paramount. The system does not explain its balance sheet in detail. It explains its intent. Purpose replaces transparency. This response is effective because the institution's legitimacy does not come from public opinion. It comes from internal belief. As long as members accept the framing, the capital machine continues to operate. Structural insulation does the rest. Assets are legally protected. Governance remains centralized. There is no mechanism for internal revolt over financial strategy. Donors cannot withdraw past contributions. Participation remains voluntary, but consequences of exit remain social rather than financial. The system also benefits from asymmetry of attention. Media cycles are short. Institutional memory is long. What appears as a major revelation externally becomes background noise internally. Time, once again, becomes the advantage. Crucially, the organization does not attempt to prove efficiency or necessity. It does not release performance data or invite comparison. Doing so would shift the battlefield to numbers. Instead, it keeps the discussion moral, where metrics are irrelevant. This approach limits damage. Scrutiny may slow growth, but it does not reverse it. Criticism may harden external perception, but it rarely penetrates the internal narrative. By the time attention fades, the system remains intact, capitalized, disciplined, and structurally unchanged. This is the final layer of resilience. Not secrecy, but framing. Not transparency, but belief. The system survives exposure, not because it disproves criticism, but because it operates on a plane where criticism cannot easily dismantle it. Power here is not defended, it is endured. In the end, this is not a story about belief overwhelming money. It is a story about belief becoming money. What was built here is one of the most efficient capital machines in modern history, not because it chases profit, but because it removed nearly every obstacle that normally limits accumulation: stable inflows, centralized control, legal insulation, long-term reinvestment, narrative discipline. Each component alone is powerful. Together, they are self-reinforcing. The system works because it is not designed to persuade outsiders. It is designed to endure. It does not need growth at all costs. It only needs time. But that strength carries risk. As assets continue to outpace religious necessity, tension becomes structural. The gap between spiritual mission and financial reality widens. External scrutiny increases. Legal frameworks built for modest institutions strain under industrial-scale capital. The question is no longer whether the system is effective, but whether it can remain legitimate as its scale becomes impossible to ignore. The greatest threat is not regulation or investigation. It is misalignment. When capital becomes the primary constraint, mission adapts to balance sheets rather than the reverse. History shows what happens when institutions outgrow the purposes that justified them. They survive, but they change. This system may never collapse. It may never be dismantled. It is too patient for that. But its future will be defined by a choice it can no longer postpone. Remain a faith supported by wealth, or become a wealth structure supported by faith. Because once belief becomes infrastructure, it stops being invisible, and power, once seen, is never quite the same again.